Hello, and thank you for joining us. I'm John Enright. This is Dan Bennett from Custom Wealth Management in sunny Syracuse, New York. And we want to share with you our thoughts, our commentary on the second quarter of 2020. Thinking back to the first quarter of 2020, not only does it seem a lifetime ago, but our world looked almost unrecognizable compared to what it looks like today. In the first few weeks of the second quarter, we began to realize the extent that a once unknown virus in the countryside of China would have on the world at large. For most of April, this virus brought global supply chains to a standstill. It also mobilized the entire global medical community into developing a vaccine in a previously thought impossible time frame. Even in our own day-to-day life, like forgetting your mask when going into the grocery store, nothing has affected as many people in such a profound and omnipresent way as this unrelenting invisible force. But this is only one of the shocks to our system that we would experience. In spite of the pandemic, or maybe besieged by it and its disproportionate effect on minority communities, our country has received a wake-up call on the state of race inequality. Since late May, there have been widespread and enduring protests throughout the country and actually in 50 other countries as well. Large publicly traded companies have changed not only policies, but actual products due to their racist origins. 100-year-old statues marking points of time once considered of significant importance in our country's history have been toppled. Even in our own practice here at Custom Wealth Management, we've made changes to our policies to recognize Juneteenth as a day of observance. These are just a few of the ways our world has markedly changed at what feels like a warp speed. So we have to ask ourselves, why wouldn't the markets not follow suit?
From the neck-twisting market decline to the head-scratching rebound that started in late March and early April, it's all but impossible to believe that since the end of April, not much has actually changed. That's not to say that everything is normal. We've come to accept a new level of steady uncertainty. There are so many unknowns when it comes to the virus and the development of treatments and vaccines, its continued impact on the U.S. and global economies, the lasting impact of the government's economic response packages, and subsequently how the financial markets will react to each of these uncertainties. As of Friday, July 24th, 127 stocks in the S&P 500 index, or 40% of the benchmark's earnings, had reported their second quarter's earnings. Where previously beating earnings were rewarded and misses were punished, in this new pandemic, market investors seem unfazed either way. In some cases, companies who have reported good results have seen their stock prices decline, while others who have reported poor results have seen their stock prices climb higher. Some companies have given up altogether on providing guidance for what to expect next quarter. This has made fundamental analysis of individual stocks somewhat complicated, placing even more emphasis on macroeconomic analysis.
What is more clear than ever is how caught up in the moment that many investors are when it comes to making their investment decisions. We have not seen the likes of this since the tech bubble of 1999 to 2000. Let's spend a few minutes on the three major markets, starting with domestic equities. Following a disastrous first quarter, U.S. stocks rebounded very nicely in the second quarter, with the S&P 500 advancing by 20% and the Russell 2500 mounting a 26% comeback. Despite this recovery, both indexes were still negative, 3.1% and 11.1% year-to-date respectively. Much of the bounce back can be attributed to the government interventions that occurred almost immediately. It seems as though the Federal Reserve and Congress had learned from the 2008 crisis to act quickly and robustly. Investors took their cues as the government was signaling that they would not let stock prices remain at depressed values for a very long time period. International equities, much like the U.S. stock market, international stock prices also participated not only in the decline, but also in the reversal, also influenced by economic stimulus from their foreign governments. Both the developed and emerging market indexes remained negative for the year, down 11.3% and 9.8% respectively, after increases of 14.9% for the MSCI EAFA index and 18.1% for the MSCI Emerging Market Index for the quarter. Fixed income, or bonds, are a similar story. The Barclays Aggregate Index rose 2.9% in the second quarter, which added to an actual positive return in the first quarter, giving them a year-to-date return of 6.1%. High-yield bonds, on the other hand, saw strong performance in the most recent quarter, jumping 10.2%. But this just wasn't enough to get them back into positive territory, as high yield bonds are still negative 3.8% for the year. The Federal Reserve's action to cut the discount rate to zero, coupled with the bond buying program, along with investors' flight to safety, can really take the credit for the bond price appreciation we experienced in the first quarter.
But the story is not over. It's one that we have seen numerous times. Precipitous market drawdowns are often followed by equally sharp recoveries. This is the nature of the law of averages. In the present case, it's very possible that investors may have been a little too eager in their wish for return to normalcy. We are of the belief that stocks have gotten a little ahead of themselves, at least in the short term, and especially in the technology, pharmaceutical, and mega stock sectors. Recent data indicates the recovery has stalled as fewer people are leaving their homes, commuting activity is leveled off, businesses are open fewer hours than they were last month, and new unemployment filings are on the rise again. These factors would suggest the recovery has hit sort of a plateau, whereas stocks are priced as if they're at more of an optimistic point in the recovery period. And as cases of coronavirus continue to rise, it's hard to believe we will be able to bring the virus under control without additional lockdowns at some point. This will further exacerbate the gap between the economy and the market.
In this time of uncertainty, it's hard to make sense of a world that no longer appears as it once did. But our purpose and our commitment to our clients has not changed. We remain dedicated to our mission to remove the stress and guesswork from building and then following a sound financial plan. To that end, we have done the necessary task of laying the groundwork to manage our clients' financial well-being through calm waters, personal challenges, and even global pandemics. We thank you for placing your trust in us, and we strive every day to earn that trust. Please stay safe, and we look forward to connecting with you very soon.